All right. Good morning, everybody. Thanks for joining. This is our third in the 12-part series of Industrial Real Estate 101. Today, we're going to jump into why warehouses should compete with apartments for your capital. First, I want to acknowledge everybody for taking the time to join us today. Time's one thing we don't get more of. Really grateful that you guys are choosing to spend it with us learning about real estate. Learning about real estate and really understanding where your capital working is one of the more important factors. A lot of people don't dive in, don't understand the concepts of what they're doing. They'll follow the crowd, follow the trend, and usually they'll realize something's wrong when it's too late. So the people who are getting ahead of it, really understanding how to be an informed limited partner, are going to have a better result. We really get excited about working this way and working with people that are excited about real estate, and we love to have the interaction. So one of the most important things we keep getting from feedback of doing these webinars so far is that the Q&A session at the end is the most valuable part. But what I'd like to do is encourage everybody to ask questions in the chat. We will get to all the Q&A questions at the end, but interaction with you guys is more why we're here than just to spout real estate information today. Um, So, when most people think about real estate investing, the first things that come to mind are usually going to be apartment buildings, maybe office buildings. Some people think about retail, but more and more often we're hearing industrial. And industrial has really become the asset class that is becoming a buzzword. It's gotten more popular over the last couple of years, but we bought our first building back in 2018, and it was a mystery. Chris Pike and I were walking around buildings in 19 and 20 with hard hats and vests, wondering why we needed these, not totally understanding how the property types worked. There's a lot of nuance in different types of industrial real estate. And it's just become one of those asset classes that the more I understand it, the more I understand the entire economy really relies on industrial real estate. It's the infrastructure for our country. So, a lot of people think industrial is just like the warehouse or the Amazon distribution center, but there are a lot other uses that make up kind of e-commerce delivery. It's contractors, it's service businesses, it's manufacturers, it's anything logistics related, truck terminals. There are all these things that we see in the economy that are kind of the end result, things you see in retail stores. Even real estate has to come from kind of materials distribution centers. Everything comes out of these in one shape or another. So, what we're going to cover today is four different types of industrial real estate. And before we really dive into that content, I want to frame it around a simple idea. When we're talking about a real estate strategy specific within industrial, it's not just whether it'll make money or not, but it's also about buying back your time, getting your capital to work for you without having a lot of work. So while the small bay type we generally aim at today is a little more managerially intensive, it also saves a ton of time and there's a lot less things to break. So if the point of real estate is to make money more passively, we're going to do all the work for you as the general partner, but the less work the actual strategy itself requires, the more durable that income stream will be. So first, we're going to dive into the industrial types that there are many of. Then we're going to talk about the key drivers and what is working through the forces that are actually driving demand within the economy, who needs the space and why they need it. We're then going to compare these to the other asset classes, the conventional apartments, office, retail, not just from a headline perspective, but really from a capital protection, time efficiency standpoint. And then lastly, we're going to dive into the niche that we're most focused on. Small bay is where we think the most opportunity is. We've got true competitive advantages in pursuing assets within small bay, and it's a sector of industrial that proves resilience even when the markets are choppy. That being said, all four of these concepts are going to build on each other. If you stay with us through the end today, I'm confident you're going to walk away with a better understanding of why the next asset we put out there is the right asset to invest in. So some of you have been with us before, but some of you, this is probably the first time. Company started in 2008. I started buying auction properties at the foreclosure auctions, gravitated towards multifamily, and has continually evolved. The opportunity has shifted over the years with growth cycles, pullbacks, periods of real uncertainty. Our 350 million of assets under management today is not indicative of our total experience. We've spent most of my career churning assets opportunistically as they make sense. Today, we own 27 properties all across the Southwest. It's a little under 2 million square feet. And the common thread amongst all of our assets is just discipline. We focus on understanding how demand behaves, where the risk is hiding, and how the capital is actually protected across cycles. A lot of people like to focus on the upside in real estate. We're really focused on the downside protection. That risk adjusted reward is the thing that we're always striving for. So, with that, I'm going to hand it to Chris Pike to dive in on some of the industrial types specifically.
Thanks, Chris. So to start, I'm going to take you through a few key categories in industrial asset class. To start is distribution facilities. When we talk about distribution facilities, this is what most people think of when they think of industrial real estate. These are the concrete tilt warehouses that you see when you're driving down the freeway that are utilized for, storage of inventory as well as logistics facilities. Next, I'll cover manufacturing facilities, and manufacturing facilities can be both heavy manufacturing facilities and light manufacturing facilities. Heavy manufacturing facilities, think of things like metal fabricators, heavy equipment uses, maybe recycling facilities, right? These are more of your down and dirty industrial real estate users that are somewhat of an eyesore but are essential to the infrastructure of the economy. And then light manufacturing, you can think of, things like people that are producing consumer goods like apparel, maybe light assembly. You've got people that are doing maybe some plastic injection molding, where they tend to look like your traditional industrial distribution facilities, but they tend to have a little bit heavier power. And you've got a user that's doing some sort of light manufacturing inside the space that's cleaner than your heavy industrial use. Next, I'll cover small bay and flex. And usually these two are lumped together because of the fact that they come in business parks with smaller units, but they are slightly different. When we say small bay, we're typically focused on more of your traditional industrial product where you've got anywhere from 10 to 30% office finish, with the remainder being warehouse. And these are users like contractors, maybe some light manufacturers, as well as occasionally a last mile distribution use. But it's a multi-tenant business park that has multiple units that are called sub 25,000 square feet with 10 to 30% office, and the remaining of the building being warehouse space for each of those users. Versus flex. Flex is a little bit heavier office build out. Think maybe 50 or 60% office build out. And this is for users that have more on-site staff. And it tends to be like R&D companies, maybe aerospace companies. These are more advanced manufacturers that have a lot of on-site staff, but still need a small warehouse for either, some sort of manufacturing or storage of equipment or inventory. Finally, the last category I'll cover is industrial outdoor storage. It's been coined IOS. You may have heard IOS before. Industrial outdoor storage properties are properties where the building comprises of a very small portion of the overall site. So you've got a small building on a lot of land, and a lot of the values derived from the zoning of the land that allows for storage of equipment or maybe storage of trucks or vehicle fleet outside, where a lot of industrial sites do not allow for that outdoor storage use. So really, it's a desirable space for tenants that need some outdoor storage or outdoor parking for equipment or vehicle fleet. So now I'm going to cover the demand drivers behind industrial. When you think about demand drivers, most asset classes have a single dominant driver. When it comes to office, it's really driven by workplace policy. Retail is driven by consumer discretionary spending. Multifamily is driven by a combination of household formation alongside wages. But industrial has several demand drivers, and when one slows down, it doesn't necessarily mean that the others do as well. So to start, I'll talk about velocity. And when you think of velocity, think about the Amazon effect. E-commerce really changed the way people shop, but it also changed, how quickly the consumer expects to receive their goods. That changed a lot of demand in the industrial space or space needs in the industrial asset class because of the fact a lot of users used to have a larger singular warehouse that may have been in the middle of nowhere, and now they need multiple locations that are closer to their end consumer. So it really increased the space needs for storage of inventory and last mile delivery. Next is inventory itself or storage of inventory. And this was heavily impacted by COVID. A lot of businesses used to operate from a just-in-time model with very limited inventory to, limit their space requirements. But when COVID brought on a lot of supply chain disruption, users or, companies started storing much more inventory on site, and this created a lot of space needs to mitigate supply chain disruptions. Next, I'll cover reshoring or onshoring. And when we say reshoring or onshoring, this is bringing, back domestic manufacturing. And domestic increases in domestic manufacturing doesn't only increase space needs for the manufacturer themselves, but it creates somewhat of a ripple effect across the industrial asset class. You know, the reshoring creates space needs for component storage, assembly, staging, as well as storage and distribution of finished goods. So reshoring or onshoring creates a ripple effect across space needs for the industrial asset class. And then finally, you have demand from trades, right? These are people that are location sensitive that want to be close to their customers, that are more service style industrial users like contractors that need to be close to their end customer. If think about being in Arizona when your air conditioning goes out, you don't want to wait a long period of time for someone to come and service your AC unit. You want someone there quickly, right? So these trades or these users have multiple locations and want to be close to their end consumer. So another benefit of industrial asset class is sticky demand. When I say sticky demand, it means that the tenants, when they find a functional location, they tend to stay in place. And so why is demand sticky? It comes down to function, scarcity, and the cost to move. Starting with function, a lot of the space for industrial users is a necessity. It's not optional space, right? So when the economy slows down, a company may slow their expansion, but they rarely give up functional space that's a necessity for their operations. Next is scarcity. So scarcity comes down to industrial zoning, right? So industrial zoning is inherently scarce because many municipalities or residents of municipalities don't want expanded industrial zoning, right? A lot of times it's an eyesore. It creates additional traffic, can be very loud, right? So therefore, what you see is what you get typically within a municipality and what they have available for industrial zoned land, creating a scarce supply of industrial zoned land. Lastly, I'll cover moving costs. Relocation for these tenants is extremely expensive. It includes downtime. It might disrupt operations. It might change logistical routes. Also creates some customer service risk as well. So when our existing tenant base see a slight increase in their lease rate, that is much more palatable than all the costs or the expense that comes alongside having to completely relocate their business. So what is the appeal behind the industrial asset class? To start, it's much simpler operations, right? There's fewer moving parts than residential or office, and there's no constant reconfiguration of the space. Next, there's less tenant improvements. So when you're talking about constant reconfiguration of the space, in office or in residential, you're constantly having to keep up with trends and what tenant demand is seeking versus in industrial, you've got more durable and reusable amenities. You're thinking like concrete floors, a very basic office. Tenants are focused on things like loading, power, and functionality, and all of these amenities are things that are durable and reusable across multiple tenants. So you're dealing with much less improvements from a tenant improvement standpoint than you are in other asset classes. And then lastly, a major appeal to tenant or to industrial is tenant retention, right? Due to all the factors that I covered in the prior slide, you see higher tenant retention in the industrial space, and higher tenant retention translates to fewer vacancies, less downtime, and more stable cash flow. So what can go wrong? There can definitely be things that go wrong in the industrial asset class. So don't want to act like everything's, rose-colored lenses. The first thing that can go wrong is tenant concentration. And when we talk about tenant concentration, you got to think of the all or nothing nature of a single tenant type building, where if that tenant vacates, all of a sudden 100% of your income is gone. So how do you mitigate that risk? You need to evaluate your tenant's credit as well as the durability of their business. Also, it's very important to underwrite or pay attention to realistic re-tenanting timelines as well as costs to re-tenant a building. And then you can also mitigate that risk through, maybe not acquiring a single tenant building, but, having a diversified rent roll where all of your income isn't solely dependent on a single tenant. Next, I'll cover obsolescence or functional obsolescence. And this is unique in the industrial space because newer doesn't always mean better, right? These tenants are paying attention to clear height, power, loading, and all of these things or all of these needs vary drastically by the end user. So I think the most important thing to pay attention to when it comes to obsolescence is understanding what your target tenant pool needs or requires, because they may not need higher clear height. They may be more focused on things like power or parking, right? So you need to pay attention to whether or not the asset that you're looking at acquiring is obsolete for your target tenant pool. And then finally, oversupply can be a factor. And this is a lot of the headlines that you're seeing within the industrial space today. You think about the big box, the oversupply in big box, right? So people can mitigate this by focusing on niches that are not oversupplied, like smaller mid-bay product type that haven't been built in recent history. You can also mitigate this by focusing on infill locations, as well as understanding the supply pipeline and existing vacancy. So I think that the key takeaway on oversupply is not necessarily just paying attention to national headlines, but really diving into sub-market or micro market supply and demand dynamics. So industrial versus multifamily. The reason why we're benchmarking industrial against multifamily is because when most people start their investment journey, they're starting in, single family homes, and then when they get into the commercial real estate space, they start in multifamily. So we're going to talk about competitive advantages of industrial versus multifamily, and specifically in this slide, how they behave differently. To start, the leases are structured drastically differently. With apartment buildings, you're typically talking 12-month leases, and a lot of the operating expenses land on the landlord or the ownership, right? Versus industrial, you might have 3 years, 5 years, or even 10-year leases that are in place, sometimes even 20-year leases. And then a lot of times the operating expenses like property tax, insurance, common area, utilities fall back on the tenant as their responsibility. So there's some pretty big differences in lease structure. Next is capital improvement and capex structure, right? With multifamily, you're dealing with a lot more intensive unit turns. Like, you see more frequent turns, as I mentioned in the prior comment on lease structure, multifamily is dealing with 12-month leases. So every 12 months, you're having to either, clean up or improve units. And you're also seeing a lot more shifts in terms of what tenants are demanding versus industrial. They're more focused on functional upgrades, things like roofs or, condition of asphalt and paving. Finally, operational intensity. Multifamily is a high-touch people business and is very operationally complex versus industrial is business to business. The tenants tend to be a little bit more independent, so there's a little bit less operational complexity. And therefore, for all of these factors, industrial can be quite a compelling asset class from an operational simplicity standpoint. So industrial versus retail and office. So retail and office are highly dependent on consumer or end user behavior. With retail, right, it was hit heavily by e-commerce and things changed pretty drastically in the space in recent years, right? And success is increasingly dependent on discretionary spending. And it's very, success in the space is very dependent on the concept. Drive-throughs have been extremely successful and local service style businesses are still successful in the retail space, but success is very concept specific. And then office, as you all are very well aware, they've been hit very hard by work from home, and there's a lot of businesses that are reassessing their true space needs and whether or not they'd prefer to have their employees working from home or whether they'd have them in office and what their true space requirement will end up being in the future. So industrial didn't necessarily get hit by both of these, and sometimes was the beneficiary of these items like e-commerce and work from home, right? With e-commerce, it really boosted space need in the industrial asset class because goods need to be stored, picked, packed, and delivered. So demand increased in the industrial asset class with the shift towards e-commerce. Also, work from home doesn't necessarily eliminate space needs. Again, a lot of The industrial space is physical in nature. Think about the service style industrial tenants I was talking about. Like these contractors need space for inventory, for equipment, for their staff, right? They need to be close to their end user or their consumer. So physical space is a necessity. So industrial demand adapts to a lot of things that have impacted both retail and office. So where does industrial fit in a portfolio, right? Industrial can be a great hedge. It can be a hedge against inflation, especially with increasing replacement costs, increases in construction costs. Industrial can also provide balance, right? With lower volatility and layered demand drivers. It can create a smoother performing asset class in a balanced portfolio of, alongside multifamily, retail, or office. And then in addition, it can create synergy, right? It can provide growth and stability during, volatile times, especially with a more operational, simplistic asset class. So a few takeaways or things that we'd urge all investors to consider when they're evaluating industrial assets is the first location, right? Industrial, you want to focus on locations that have proximity to highways, that are near population centers, and are near labor pools. So you might hear us frequently saying, hey, we're focused on infill locations. This is exactly what we're talking about. Also, as it relates to location, you want to pay attention to the zoning because the zoning can highly impact, the use that a tenant can what a tenant can do at a location, right? So pay attention to both infill locations that have proper zoning. Next, you want to pay attention to tenant quality. How many tenants are in the rent roll and drive their revenue? What industries are they in? Are they, inelastic type of industries? And are their businesses discretionary or are they essential? Next, you want to look at functionality. And like I said, tenants in the industrial space are very focused on things like clear height, loading, power capacity, and it's not created equally for all tenants, right? So one tenant may focus on clear height versus another may be focused on power. So I think the very key takeaway when it comes to functionality is paying attention to what's important to your target tenant pool for that specific asset. Finally, track record, and this is one if you've joined any of our prior webinars, this is one that we've harped on frequently, right? Industrial sounds simple, and it is sometimes more operationally simplistic than office or than multifamily, but execution still matters. So you want to seek out, sponsors with a strong track record. Past experience doesn't necessarily guarantee a great outcome, but it does reduce avoidable mistakes through, proper underwriting, understanding tenant behavior and leasing cycles. So that's it. That's those are the key takeaways. With that, I'm going to pass it off to Ted to take you guys through the rest of the presentation.
Thanks, Pike. My name's Ted Oss, Managing Director of Investor Relations here with Hanson Capital. So thanks for joining us and sticking around. We'll have some Q&A at the end of this. So what is small bay industrial? When we talk about small bay, we're talking about warehouses in the back, offices in the front. These are properties for businesses that need a place to store their equipment, their trucks, as well as a staging area for their crews, while also having an office to support the administrative functions. These are smaller units, oftentimes between 3 to 10,000 square feet. These properties typically have several or more tenants. So the property we just acquired in Houston has over 110. So instead of relying on a single tenant for rent, we have many. The types of users here are contractors like electricians, plumbers, drywall, trades. These are local service style businesses that support local repeatable economic activity. And these tenants don't need flashy space. They need reliable functional space close to where the work is. Why small bay? If you look at the recent development pipeline for industrial, less than 2% of the new supply is servicing bays under 25,000 square feet. Has not penciled to build small bay. So there's a significant supply and demand imbalance. Most of what's been built over the last 5 years is servicing bays 100,000 square feet and up. So in markets with increasing population, the demand for small bay has grown, and there's a need for more businesses to service the residential growth. So it's created a significant supply and demand imbalance, which has led to strong rent growth and low vacancy rates. Higher retention and operational stickiness. So these tenants have built their operations, their customer routes, and workflows around a specific location. As long as the space functions and rent stays within reason, these tenants tend to stay. And then that retention reduces downtime, leasing costs, and operational volatility for us. This asset class is often under the radar. Small bay is overlooked by larger institutional capital. The deals are smaller. The tenant base is fragmented. and the management is more hands-on. So it creates an opportunity for disciplined operators to acquire and operate these assets with less competitive pressure, and less competition can support better entry pricing and more rational returns. And then tenant diversification. So the property level income is spread across multiple tenants, and the diversification smooths income, reduces reliance on any single outcome. So small bay industrial offers durability, but it also has a different set of risks. And the key isn't avoiding the risks, it's managing them intentionally. So rollover frequency is a common risk in small bays. It's the frequency in which tenants roll over. With more tenants comes more leasing events. This means more leasing activity over time and more potential for short-term disruption. Smaller tenant credit, another common risk in small bay is tenant credit. Many of these small bay tenants are local or regional businesses, and they don't have institutional credit ratings, and their financials can be less standardized. So it doesn't make them weak, but it does require more due diligence. Operational complexity, a small bay industrial brings on additional risk. The fact that we're managing multiple tenants across multiple units requires more hands-on oversight. This is not a set it and forget it asset. Operational complexity increases the importance of systems and experience. So the way we mitigate these risks, diversification is going to be our first line of defense. We implement proactive leasing, addressing renewals well before expiration. We will track our tenant health, anticipate needs, and maintain visibility into upcoming rollovers, which will help reduce downtime and improve retention for us. So small bay rewards active management. Hands-on oversight allows operators to respond quickly, solve problems early, and maintain functional relevance. So it's more work, but that's also why the niche remains less competitive. So some key takeaways, industrial real estate isn't optional for the economy, it's infrastructure. Apartments respond to where people want to live, retail responds to where people want to shop, and office responds to how companies decide to work. Industrial responds to what has to happen for the economy to function. So that makes industrial less about preference and more about necessity. So let me say that again because it's important. The others are preference, industrial is necessity. Demand is driven by long-term structural trends. The demand drivers behind industrial aren't trends you're betting on, they're structural realities. So it's speed of delivery, supply chain resilience, physical services, and domestic production. So even when growth slows, these don't disappear, they adjust, but they remain. And so it's also extremely important. Industrial has a lower risk profile than assets that rely on discretionary behavior staying strong. So office demand may fall as people decide to work remote, but people will always need food and shelter, which rely on industrial to support supply chains and distribution, as well as the infrastructure for the entire economy. Small bay is a compelling, underappreciated niche within industrial. Small bay amplifies those advantages. You're not relying on a single tenant, one industry, or one outcome. You're serving dozens of essential businesses that are location dependent, operationally tied to their space, and costly to displace. So that creates three critical strategies for risk mitigation, which are diversification, retention, and stability, which you'd have a hard time finding in other asset categories. So why should small bay compete and win over multifamily for your capital? Multifamily is a great asset class, but it's not designed to do everything. It's more management intensive, more exposed to policy. If you think about rent control popping up in more and more cities, that is not the case with industrial. And when you think about multifamily, rent often represents somewhere between 25 to 40% of the tenant's income, while with industrial, rent is typically between 1 to 5% of their revenue. So they aren't quite as sensitive to rental increases. So industrial, especially small bay, tends to do the quiet work better, fewer decisions, fewer surprises, fewer forced moves. So if the goal is to grow wealth and protect time and to reduce volatility without giving up relevance and to own assets that still matter when the cycle turns, then industrial isn't just an alternative, it's often the superior choice. So with that, we've got a couple minutes left for Q&A. First question, this would be a good one for you, Hanson. Are you guys going to look at any multifamily deals in the next couple of years or focus on strictly small bay industrial?
Yeah, we're definitely still looking at multi. A lot of the transactions volumes down. I mean, the multifamily brokers are crying more than probably any other broker. Their joke is they're the new office brokers lately, amongst the ones we're close with. So volumes way down. The transactions that are happening are generally lender induced or, not full on foreclosure, but lenders, defaulted them and we've been involved in some institutional discussions on that. I don't really like the asset class today because rents are still trending down. I think our Q4 report both in Phoenix and most places in the country. It's not the whole country, is still rents going down. So all commercial real estate's valued as a function of the income it produces. As rents decline, values decline. I don't see any benefit to being early. And that could be a controversial statement because there are people that will say, hey, today's the time to buy while prices are still down. Very well could be not about timing the markets for me as much as it's assessing all the alternatives or choices on the table. And in the sector that we're focused on today, we're seeing rents rise. Therefore, we're seeing values rise. It's not going to win my dollars today. I'm still a multifamily owner. We built a project, 128 home for rent project in Dallas that finished in late 22, started 23. We'll buy things when the price is right. Today, I don't think they're priced right.
Cool. Mike, this one's a good one for you. How do you assess the electricity supply to these industrial properties? Are you seeing higher electricity demands from tenant? And have there been opportunities you've passed on because not enough electricity supply?
Yeah, I think that goes back to what I covered in the slide deck in terms of you need to focus on what your target tenant pool demands, and that can vary pretty drastically depending on the category that you're pursuing within industrial. So, for example, if you're, acquiring an industrial manufacturing facility, you need to be very conscious of the power capability because the majority of your tenant base that you're targeting for that property is going to be highly sensitive to the amount of power they can access. So that's something you need to assess and then understanding, you can connect with brokers in the space of, hey, what kind of power needs does a typical tenant need for this type of building and making sure that your asset covers those power needs, right? But on the opposite end of the spectrum, if you got, a space that's utilized for dry storage or storage of inventory that's just going to be distributed down the line, those users are probably less sensitive to how much power is available at the site, and that shouldn't, drive your decision. They're going to be more sensitive to things like clear height and how much inventory can they store in the building, right? So power is definitely a very important factor to consider, but it's you again understanding what your target tenant pool needs or requires, and then, backing into your acquisition assessment based on what your target tenant pool needs.
Great. Hanson, here's one for you. I
Chad,
see. Yep.
one more thing on that question about the electricity supply. I wouldn't say we've passed on many buildings for not having enough power. We view it more as a value add. So the building we bought back in July was way overpowered, and we've been able to get some rent premium out of that. But I want to make sure we differentiate that that's a feature where there could certainly be an underpowered building, and getting electricity out of the service providers these days is a really difficult problem. We sold one of our buildings recently, or it's an escrow to Brookstone, one of the large REITs out of New York, for a data center conversion because of the power it had. So it's more like a value add than necessarily a detractor. And that's worth noting. Sometimes you'll find, and there's way more than expected, but it's rare that they're like severely underpowered for most needs.
Cool.
Sorry, Ted, what you were saying, another one?
No, one other question. I see more and more small bay industrial building. How does this compete now and into the future with Hanson's investments?
We're not seeing a lot of new small bay, at least in the infill areas. So I think it's important to differentiate. If we look at the growth of industrial supply over the last 5 years, it's like 2% for the 25,000 smaller bays across the US. So macro numbers are great, but they tell a story, whereas the 100,000 and up, I think, is up 25 to 30% in that same time period. New supply is definitely an issue because the supply demand imbalance is what we're capitalizing on. But the areas we're focused on are going to be more supply constrained. Like, for example, Austin, Texas has been a really hot market the last, 7, 8 years, probably, maybe since COVID, for real estate in general. But what I don't like is all the green space or developable land around it. So as soon as you move outside of the city center, there are a lot of emerging areas there, but there's so much undeveloped land that could come in and bring new supply online. I'm fearful of that. So at a macro level, yeah, I have concern over oversupply at some point, but it doesn't pencil to build the projects that we're targeting, which are going to be infill, existing in supply constrained areas where just the math will never work to projects that exist. And because the users, I'll say, requirement of proximity to their customer base in general, that's more the service users, delivery users, and people like that. Those guys are not going to have an alternative that's a nicer, newer box, down the street because we're focused on not just the supply that's already in the market, but also what the building permits look like, and more importantly, what the land is looking like. Because we are also a developer of this product, so we're not looking at this purely from a we're going to buy it because that's the only play we understand. We will build it where it's appropriate. Just in the last couple of years, we haven't found the risk reward profile or the sites and the construction costs aligning for us to go ground up. We got really close, kind of mid 25 before the Liberation Day threw the supply chain into a tailspin again. So we're not opposed to developing it, but we're going to keep an eye on the supply side.
Perfect. Pike, here's a good one for you. What markets are you most active in, and where are you looking to buy right now?
Yeah, so we're most focused in the Southwest today, right? So we're talking about Arizona, major markets within Texas, which is, DFW, Houston, San Antonio, Austin area we're looking at, but more heavily active in Houston and DFW. Then we're also looking in Las Vegas, Salt Lake City, and Denver. And we've expanded other markets as well, trying to find assets with yield. But where we've historically operated and been the most heavily focused is Arizona and Texas. And the reason being, we're finding a little more opportunity in Texas today than we are in Phoenix, specifically from a yield standpoint. Houston and DFW are offering assets where we can buy at a little bit lower cost basis as well as a little bit stronger yield. That doesn't mean there's no opportunity in Phoenix. It's just harder to find the right opportunities at the right entry pricing today.
Cool. That's actually a good segue to the next question. Hanson, for you, is industrial pricing too aggressive today?
Uh, that depends. We sold 5 assets week before last to JP Morgan's subsidiary. That pricing was way too aggressive. That's why we took it. We couldn't make sense of holding those assets at the price they're willing to pay. JP Morgan's been pretty vocal about being very bullish on industrial and logistics real estate. That being said, if we have other assets that we've put in the marketplace that we weren't happy with the pricing on, and we're buying things. The deal we bought in December in Houston at $100 a foot, I think we'll look back as one of the home run transactions we did. We did 5 transactions in 25. And that one I think was the best by far. And it was a 34 million, $40 million total capitalization deal. So I think our pricing is, or our differentiators, our discipline around pricing. Chris Pike and team review 600 to 1,000 opportunities a month across 12 different markets now. And I know that number sounds huge, but we have over 2,000 brokers that are sending us deals. And I know last month in January, we didn't secure a single deal, and we wrote plenty of offers. So pricing is really a function of that balance between buyers and sellers, and we're going to be on the aggressive end on the buying side. I think you make money on the buy. It's great when you get a big buyer to buy something from you and overpay in theory, but that's more luck than discipline. So I'm focused on buying right. I don't think the pricing's too aggressive in general.
Cool. Mike, here's one for you. How do you get comfortable underwriting smaller local tenants?
Yeah, so there's a few different ways we look at call it local or regional credit, right? You're going to look at their financials, you're going to look at the durability of their business, how long have they been in operations, what is the trajectory of their business, and then whether or not you can, another tool we utilize is getting personal guarantees from the user as well, right? But I think the biggest way to mitigate that risk is through diversification within the rent roll, specifically within small bay tenant turnover due to businesses shutting down or shifts in the business's needs do occur. And so you kind of mitigate that risk through having a diverse rent roll. And then you can also mitigate it through, securing things like personal guarantees and doing your front end due diligence on, hey, is this a durable business? Do we still see them in business 5 years from now? And is this rent truly affordable to this tenant based on their P&L and their balance sheet or their historical financials that you're reviewing?
Cool. This one could go for either of you. Do you prefer older functional product or newer construction in small bay?
I, you want me
Mike,
to?
you go ahead and start. I'll give an answer too.
Cool. You know, I wouldn't take newer product over older product as a blanket statement, right? By nature, newer is probably going to be slightly more appealing for a variety of reasons. But, a lot of times people need to be in a location out of necessity, not out of, hey, this one looks prettier, or, it may be more appealing to our customers when they come visit our location, right? A lot of times people need to be in a specific location because it's easier for them to get to. It takes their staff less time to go service their customer base, et cetera. So it's just financially makes a lot more sense. And the difference between the existing older product is not something that's significantly impactful to their overall operations, where the location can be significantly impactful. So I think, generally newer product is great, looks better, but it's, there's other driving factors, specifically location, that you can't replace with older product. And a lot of older product can still be very functional for your end user, that they may not need 24-foot clear height. They need somewhere that's close to their end user, somewhere that's close to their employees.
Cool. Do you have anything to add there, Hanson?
I think Chris Pike nailed that. The only statement that I would add is there are a lot of people who would say newer is always better. And I agree with what Chris said for all the same reasons he said. The caveat to that, I would say, if everything else were equal, would I rather have a newer product than an older product? Yes, but I take location over product quality every time, because with the ease or simplicity of these are large boxes with an office that you can renovate for, 20 grand. It's not rocket science to keep these things functional, yeah, to use that phrase.
Cool. Let's do one last question, Hanson. Does industrial offer enough upside compared to multifamily?
Uh, that feels like a trick question, because I'm a multifamily owner. I like multifamily. I think multifamily today is not priced attractively compared to industrial in most instances. That being said, I think we've made a lot of money in multifamily over the years, and I think we will continue to make a lot of money in industrial. We'll be making a little bit more these days, because I think there's a better opportunity to see upside with the industrial fundamentals today. I'm always a believer of buying things below replacement cost, with below market rents. So when those things are true and we can stabilize in the yields we're looking at that are, I'll say, somewhere between 8 and 10, those are numbers I'd want to own. And as soon as multifamily can match or exceed that, I'll buy more multifamily. But today that balance swings towards industrial. Okay, perfect. Thank you guys, everybody, for showing up today. We really appreciate it. We appreciate the questions, and we look forward to continuing to help. If you have any feedback you can give us for topics, other things you'd like to see, that would be wonderful.
Thank you.